Hi everybody, welcome to the channel. In today's video, we are going to talk about a very important topic that is imminent for us to cover in today's video. As you are already aware that the US and the Iran talk did not go as expected, so you can expect a lot more volatility in the global as well as the Indian stock market due to the geopolitical uncertainty. And that is why this particular video is going to help you in preparing yourself for the next few years, as we are going to witness history to turn around in the next 5 to 10 years. So, without wasting any further time, let's quickly dive into the topic for today, which is, can this be a lost decade for the Indian stock market? Now, why do I say so? Because in the last 1.5 year, if you have seen Nifty return, ideally it is at a 0% return for the last 1.5 year, which is September 23 to April 26th, which is about 2.5 years. I'm sorry, correct, which is about 2.5 years wherein Nifty has not given a single return. Now, in the same period, if you look at the FII outflow, you see that there has been about 3 lakh crore worth about invest outflows from the foreign institutional investors. To add to that, Rupee has depreciated by about 11% in the year 26 itself. And to add to that, there has been about 5% inflation. So technically, for the last 2 years, approximately, the market has given minus 20% return. Now, is this the very first time that is happening across any market? The answer is a no. If you look at the chart on your left hand side, you see the Japan index, which is the Nikkei index. For about 35 years, it has given approximately zero return, starting from 1989 to 2024. This we see a very similarish pattern of about a 50% return in UK FTSE 100 between the year 1999 to 2014, which is approximately a period of 15 years. 15 years, 15 per, right? Now, if you see the dot-com bubble, which happened in the S&P 500 and Nasdaq in the US market, you see for the dot-com bubble, it took almost 15 years to recover on Nasdaq, and S&P took about 13 years, that you can see on the chart, right? So what we are trying to conclude from this particular slide, that over a long period of time you can see a market correction or market consolidation that can happen. It has happened with other stock market, it has happened with Japan, it has happened with UK, it happened with US. Who knows, it can happen with India as well. But the underlying reason for all these market has been a stretch valuation, earning disappointment, FII moving out from that local market, and what you call a stagflation. Now, I'm sure that with all these keywords, the word that comes to your mind, that is India going to be the next market where we can see almost a period of 5, 7, 10 years where the market will just move sideways. Now, before we answer that part, just let's go back to history. From 2020 to 2024, which is approximately 5 years' time from the COVID bottom, you see a very good return in terms of the Indian stock market. And few of the reasons were a huge amount of retail participation. To give you some numbers, about 13.6 crore new demat account opened. So in 2020, there were only about 4 crore demat account. With that of 2024, it was 13.6, so 4x number of demat account, which means a good promise shown by the retail participation. Now, to add to that, there has been a record high number of monthly SIP inflows to a tune of 20,000 crore. So you see a huge number of retail participation going up, retail bringing about 20,000 crore worth of corpus adding to the Indian stock market, which actually led to the output that there has been a 62% gain from India indices in the MSCI Emerging Market Index. And in the same time period, the Nifty, because of the strong earnings growth, you see a Nifty PE correcting from that of 34x to that of 22x. So reason for all this growth of a 245% rise in return in 4.5 years is led by profit-led growth, which means it is just not speculation. The companies are earning the profits, and that's why their valuation is growing high up. Number two reason what we covered is a retail surge. High number of participation from retail, both in terms of new participation and in terms of SIP inflow. Number three, the valuation also got re-rated, and because we also saw globally the FII, there has been a strong inflow of FIIs in the Indian market to a tune of about 1.7 lakh crore in 2023, where India was positioned to be the next big thing in the hot market out there. But as we step outside 2024 towards the end of it, what we do see is a market correction. So from that September 2024 till April 26, right, 1.5 year has gone by, and ideally the market has corrected. It was not able to reach the highs. So almost a 0% correction, with few of the major mid cap, small cap, few larger to smaller companies correcting by a higher margin compared to the large caps. So mid cap has corrected by 26%, small cap corrected by 32%. The rupee has depreciated by about 11%. And if I consider the rupee depreciation with that of inflation adjusted, about 15 to 20% correction. Now, if you study this fall, now the as I always say that the price is basically an output of few of the leading indicators, which are the earnings misses, FII is going out, rupee is collapsing, there's geopolitical risk, which is affecting a country like India who exports so much of crude oil from outside. And then there is a valuation trap added to it, which means that there are other markets which are offering far better valuation compared to that of India. And in terms of the real growth, there hasn't been much growth because of a global uncertainty, rupee depreciation, FII is leaving. The growth hasn't really transpired. So these are broadly the reason why from September 2024 till today, for the last 1.5 year, broadly India has seen approximately zero return, with few of the smaller indices correcting by 20 to 40%. Now, what I'm trying to get at from all this analysis is the fact that India can lose its opportunity. Yeah, you heard it right. While India is positioned to do very well, but unless you see these things to evolve and these things to correct, I really doubt whether India will have a 15% growth, CAGR growth over the next 10 years, which is what we are promised. And sometimes we feel entitled, but that actually isn't the case. Let us talk about a couple of uncertainties over here. Number one, a valuation overhang. So compared to the other emerging market, India currently is trading at a 22 P. So if I remember about the P, when Japan in the year 1989, since when the consolidation in Nikkei happened, Japan's P was 60 times. So mean reversion can definitely take place. Now, one of the very important factor which drives this PE, what is P? Price to earning. Now let's talk about the earnings, which is the denominator part. So if the earnings per share growth stays at 8 to 10%, this multiplier of 22x will compress further. And then you will say Nifty will go nowhere for years. Add to it, recently FIIs have started taking strong position in the other emerging market, especially Korea, Taiwan, Japan, China again opening. With all of these things, India is not the only market where the FIIs are looking. There's other kids in the block as well. The fourth point, because India is structurally a high export driven economy, the rupee will fall. The rupee has been falling, rupee will fall, which is leading to a lot of trade deficit, oil dependency, especially from the Gulf. Then there is a fiscal deficit that happens. And if this continue, then rupee can well slide above 100 rupee to a dollar by 2030. And there's geopolitical uncertainty as well. If I look at all the neighbors of India, we do not have a very good relationship with them because of whatever reason. So this video's purpose is not to make things political. It is only to answer a few questions at how politics can shape our investment. Pakistan, we are not in the best of terms. Bangladesh, Sri Lanka, China, right? And because of all of these things, added to the fact that US tariff, the global supply chain can be very, very disruptive. So India needs to play its cards very well. To add to that, I'm sure you guys have heard of the layoff, unemployment rising. Because India houses so much of talent, if AI is leading to a lot of apocalypse, many of the Indian youth will lose their jobs, who are the tax-paying citizens of India. That will have a colossal effect in the economy, in banks, in real estates, in automobiles. So it's just a very much ticking time bomb. So guys, the purpose of this video is not only to scare you away, it to provide you some bit of rationality that what could go on, and that is what we have to learn from history, because it's all a law of probability. Now, let's look at how can we survive in this market. And the answer over here is only one, which is diversification. So consider the same time period, which is September 23 to that of April 26. If you had invested 100% in the Indian stock market, ideally your returns would have been minus 9% in rupee terms. In rupee terms, minus 9%. Now, had you done a 60-20-20 split in Indian stock market, what I mean by 60-20-20 is that 60% in Indian stocks, 20% in debt, 20% in gold. Your return would have been 18% for the same time period. I'm not done yet. Now, here's the interesting part. Now, had you done a 60-20-20 for the same time period, but out of the 60, where previously you had 100% Indian market led allocation, you split that to US 50, India 30, Taiwan 8, Korea 7. In that case, your returns would have been 42%, which is the one in the middle, 42%. For that, the diversification is a 60, 20, and 20. 60 is equity, 20 is debt, 20 is gold. And out of the 60, you split that into four buckets: US 15, India 30, Taiwan 8, Korea 7. Now let's move to the fourth bar, which is the gold. So here you allocate 100% in gold. You have a 38% return, and you invest 100% of your portfolio in US S&P 500. You would have got a 55% return. But you don't know whether gold is going to continue with the bull run that it promised in the past. You don't know whether US will continue with the 55% return forever and ever. So my friends, that brings me to the conclusion. While there can be better opportunity that you can see right now with 100% allocation in US S&P 500 or that of Taiwan or that of Korea, which has given 76% return in 2025, Taiwan 44%. But it does not mean that it will push 100% of your portfolio to that one particular index. It's very risky. Rather than that, what you should be doing is to split your portfolio across equity, debt, gold, and you can see that by numbers, a 42% return is what it was able to achieve versus having 100% of the exposure in Indian only in the Indian equities, which would have given you minus 9%. So in times such as this, wherein you can see extreme volatility, this is the right balance that I would recommend for you guys, and that is a thought I want to leave you with. That do you think that the Indian market is going to do a 15% compounding CAGR for the next 10 years? And do you think by adding a proportion of gold as well as debt like bond, as well as US, Taiwan, Korea, along with Indian market can supplement the growth of your portfolio? On that note, guys, thank you so much for watching and see you the other time. I hope that you like the video. Please do click on the subscribe button and the like button. Thank you guys. See you again. Have a good one.